If you're 62 years or older, there are three ways that you can purchase a home. The first one, traditional financing, and my office can help you with that. However, there's an issue for retirees with traditional financing that no one is talking about, and that's loss of income and a mandatory principal and interest payment. You see, if you have a 15-year mortgage and before you've paid off that mortgage, there's a death of a spouse, there's a good chance that the surviving spouse has lost a significant portion of their income. It's also a good chance that that's put the surviving spouse in a very difficult situation and may force them to sell. The second option is cash, which is a good option to eliminate that principal and interest payment. However, by utilizing cash, you're taking a very liquid asset that you have set aside to pay for insurance, groceries, or whatever you need from day to day, and you're putting this into a hard asset that's difficult to access. The third option is a home equity conversion mortgage, or HECM. And how the HECM loan works is a lender can lend you based on three factors: your age, the interest rate, and the purchase price. This will vary from individual to individual based on these factors. For very simple explanation purposes, I've taken a $600,000 home and just cut it in half. So in this example, the HECM loan is $300,000, and the down payment is $300,000 as well. The down payment can come from any source that is a non-borrowed asset: checking, savings, 401k, stocks, bonds, mutual funds, whatever it may be. But for this example, we're going to show somebody selling a home that is no longer suitable for them. Maybe there's too many stairs or the yard's too big and they want to purchase something more suitable. So they take this $300,000 home or $300,000 in equity from the sale of their property, and they use this as a down payment. Now, what have they accomplished? They've accomplished two things. One, no debt service. There's no required principal and interest payment. But not only that, they can make mortgage payments. Most people forget that. Our office can show you how to pay off your HECM loan in 10 years, 15 years, 20, or 30 years. It doesn't matter. But the benefit is the flexibility, because if there is a loss of income, the surviving spouse can then decide, do I still want to live here? And if the answer is yes, can I afford to live here? And if the answer is no, they can simply stop making their voluntary payments. The second thing they've accomplished is their liquid assets. They've preserved their liquid assets that they have set aside for groceries, insurance, or whatever their daily needs are. If you would like to make sure that you're exploring all three of your options, not just the first two, give my office a call.